Welcome back to another video in the index comparison series. We're nearing the end of December now and have just about a full year's worth of data to look back on and possibly provide some judgment on how these ETFs can perform alongside the respective indexes. This has been the most popular series on the channel so far, and so if you need to catch up, I would watch previous videos where I do deeper dives into why we compare certain indexes and also into some of the components within each of these ETFs. So if you own any of these ETFs and want to keep up with these updates, feel free to help out the channel by subscribing for future videos and giving the video a thumbs up. These videos take a long time to make because of all the animations and extra details I include in each video. So if you can also share the video with those who might be interested, it would greatly help the channel grow. Now let's get into the comparisons. So here I'll quickly go over and review the parameters of this comparison for those who are new and joining the series for the first time. For this series, we're focused only on enhanced covered call strategies, which means that all these funds use a degree of 25% leverage. But why use leverage? Because the extra 25% boost helps mitigate some of the upside that can be capped with a covered call strategy and brings the performance closer to the individual indexes. The comparisons will begin from the start of 2024 because that's when all the underlying holdings within HYLD and HDIV were updated. Now these comparisons are going to be very straightforward and as simple as possible, and the first one will be purely based on the stock price itself. The second comparison isn't much more complicated and is just simply adding the dividend distribution that's been paid out to shareholders back into the fund. This is because when the ETF pays out a dividend distribution, it comes from the fund's earnings being transferred to its shareholders. So by adding back the dividend distribution, it'll give a sense of what the total return would look like if those earnings were retained in the fund. And lastly, here are the ETFs and indexes that we will be comparing. The main reason for these specific indexes is because of the currency hedging component of each ETF. The difference is that an unhedged ETF will be exposed to the currency fluctuations between the Canadian dollar and the US dollar exchange rates. And then a hedged ETF will have the impact of those fluctuations removed by the fund, so that the returns will reflect only the stock price movements of the underlying for more stable returns. Now with all those details out of the way, a lot of this video is going to be looking at this next part, which will influence the future of these videos going forward. As I continue to do these videos over this past year, I've been noticing that the values I've been pulling from investing.com have been diverging a bit further away from other sources like Google. It's come to the point where I've been starting to question the validity of these values and how accurate the results are. And of course, as you can expect, I did a deeper dive into various sources in order to come up with a more accurate conclusion for the results. So how we're going to compare all these sources will be a little bit subjective, but I'll go through all of them individually so you can see the decisions made for each one. The general criteria is to first look for confluences and values between at least two sources, and then determine if the others are within an approximate 1% difference, either above or below that value. This criteria isn't going to be super strict, but it'll just be a loose guideline. An example would be if source number 1 and source number 3 are both around 13%, then that would be considered a confluence. If source number 2 is outside of the approximate 1% range, between 12% and 14%, then it will be deemed unreliable. If, for example, source number 2 is 12.5%, then it would be considered close enough and be accepted as reliable. But if source number 2 was 11.5%, then it would be considered unreliable. Of course, this is in no way the most reliable way to determine if a source is reliable or unreliable, but it'll give us a general idea of how these compare to one another. Also, just a quick note is that all of these screenshots were captured over the weekend after the market closed on December 20th. So that way the values had time to settle and should all technically show the same values. So to start with VFV, for price return we have 4 different sources, and it looks like investing.com seems to be the outlier here at 30.85%, with the other 3 sources finding a confluence in values at either 35.27% or 35.29%. Then for total return, there are 3 different sources, with investing.com at 31.7%, and then the other 2 finding confluence at 36.04% and 36.25%. So to come up with a verdict, this one seems pretty clear cut that investing.com would be seen as the unreliable source when it comes to comparing the values for VFV. Next is USCL, and for price return it's similar to VFV, where investing.com is the outlier at 19.73%, while all the others are in the 23% range. But in terms of total return, it seems like there isn't a confluence between any of the 3 sources. While they are all within 1% of Seeking Alpha's 34.99%, they are all greater than 1% from each other. So I have to say that all 3 of these are unreliable because there was no confluence. So for USCL, the price return is clear with investing.com as the unreliable one again, but there's no decision to be had for the total return. Now for VSP, it looks like we have 2 sources finding confluence at approximately 23.4%, but then the other 2 are a bit tricky to say. While each one individually does fall within the 1% of the confluence value of 23.4%, they are on opposite ends of the value away from each other. This is where it gets a little bit subjective, and I'll be saying these 2 would be unreliable. And then for total return, we are in a similar situation as before, where there isn't a confluence between any of the three values. So all of these would be unreliable. Things aren't looking good for investing.com so far, with everything in the red, but in general, things are looking pretty mixed at this point, with nearly equal amounts of green and red on the board. For HYLD now, we have a turn of events where I've given all of these a reliable rating. You could say that it's a pity point for investing.com, with it being slightly out of the 1% range from 12.5%, but I think it's close enough if you were to take the 1% range from the average of the other three values. Then in terms of total return, the values are a little bit far apart between investing.com and Canada's stock channel, but it's still within 1% of each other. So the outlier here would be Seeking Alpha. In general, it looks like for HYLD, all the sources are fairly reliable, with the majority of them being green. We also finally have our first reliable ratings for investing.com, so let's see if this can continue going forward. Moving on to QQC, we have three sources that are all within range of one another, and then investing.com being the outlier once again. Total return wise, we again have all three sources returning different values from one another, so all of them are going to be marked as unreliable. It's starting to become fairly clear that the price return are generally close between all of these, but total return seems to have quite a bit of variance. Similar to VSP earlier, we have confluence between two sources with identical values, but then the other two sources are opposite ends away from each other. So for consistency, we'll mark these two like we did earlier, where it's split 50-50. With the total return, we have investing.com and Seeking Alpha finding confluence with each other, and then Canada's stock channel being the outlier. At this point, we haven't seen a clean sweep yet in either direction for all of them being green or all red. Now with XIU, we see another one where all of them are all within 1% of one another, so they'll all be marked as reliable. Unfortunately, for the total return, we have investing.com showing a drastically different value from the other two, so we don't have a clean sweep. Yes, the value between Seeking Alpha and Canada's stock channel is slightly greater than 1%, but it's close enough that I think it can be counted. Here again, we see fairly good confluence between all the sources for CNCL, with all of them within 1% of one another. And unfortunately again, we miss out on the clean sweep, with Seeking Alpha this time being the outlier for total return. Finally, in this last comparison for HDIV, we are in the same situation again, with all the values for price return being within 1% of each other. But unfortunately again, we miss out on the clean sweep, with Seeking Alpha being the outlier again for total return. So now let's total these up and figure out what the scores are for each of these sources under the individual categories. Starting with investing.com, we'll first look at the price return. If we total up the number of greens and reds, we get a total of 4 greens and 5 reds. So while it's almost even, we'll have to give it a red or unreliable rating when it comes to price return. When it comes to the total return, we have an identical score of 4 to 5, which unfortunately puts it again in the unreliable column. On to the next source, which is Google Finance, we have 7 greens and 2 reds. While it's not perfect, the score basically speaks for itself, so there's not too much else to add. With Google Finance, we aren't able to track total return, so we'll just move on to the next source. With Seeking Alpha, when we add up the totals, we see that the price return receives a perfect score of 9 greens, which means that the value always finds confluence with another source. Then for the total return, it's showing a little bit of the opposite, with it receiving 3 greens and 6 reds. So this actually puts it in the unreliable column, which is a bit surprising, seeing that it's probably one of the most used resources out there to compare and do research on stocks. We then have Yahoo Finance, which actually receives the same perfect score for price return as Seeking Alpha, which means both of these always had their values match or being very close to one another. And with Yahoo Finance, we aren't able to track the total return, so we move on to our last and final source. With the Canada stock channel, we are unable to compare the price return, so we'll just look at the total return. For this, we have 5 greens and 4 reds, which gives it a slight edge and placing it into the reliable column, being the only one there. This is good to know because it's been a very useful tool that I use a lot for comparing dividend ETFs. So to summarize all of this together, let's once again go through each category, then provide the overall thoughts for what sources I'll be sticking with going forward for these comparisons. For the price return, it's fairly obvious that the two winners here will be Seeking Alpha and Yahoo Finance. Google Finance is also very close as well, but looking at the values once again, it might appear that Seeking Alpha and Yahoo Finance could possibly be using the same source for the numbers due to how identical the values were. While with investing.com it ended up in the unreliable column, it was still very close to a passing grade. So the numbers are not completely unreliable, but should be taken into consideration that they are a little bit off from the others. Now looking at the total return, we only have one source that ended up in the reliable column, and that is the Canada stock channel. Investing.com was also fairly close to being in the reliable column as well, but missed it by 1 point. Then the one with the worst score here is Seeking Alpha, which I already mentioned was a bit surprising to see. So hopefully I haven't lost everyone already by looking at all the values from these sources. It was a lot to go through, but I think it gives a rough idea of how all these compare to one another and how they stack up in each category. One thing that is apparent though, and that is how we never ended up getting a clean sweep where all the values were congruent with each other. There was always 1 or 2 values which differed drastically from the rest of the group. It goes to show that you can't just rely on a single source of truth, and that you should do your own due diligence across a few of them in order to get a clearer picture. And this is where I would like to get some of your input on how we should move forward with these comparisons, and what sources we should be using that you think would be the most reliable. My picks would be to keep with investing.com because it allows me to export the values to keep creating these spreadsheets, but of course, as we've seen with the price return, it can vary greatly and could impact the overall accuracy of the results. And then I would also continue to cross-reference it with the Canada Stock Channel results because of how it ended up being the most reliable source of the three we looked at, and because of how it also shows what it would look like with dividends reinvested. So in the comment section below, let me know your thoughts, and whichever seems to be the majority, we'll carry on with that going forward. Now let's finally get into the actual review and look at some charts. To start, we'll go over the S&P 500 comparisons with USCL and HYLD. Starting with VFV and USCL, as we can see at the start, they were performing together with USCL taking a slight lead during that time. Until the dividend distributions start getting paid out at the end of January, we then see the two begin to diverge. This is normal, and for those who only look at the stock price chart will say that USCL is underperforming, but this is not the case. You have to keep in mind that the distributions being paid out are also part of the total return, and we'll see that later on in the chart below. Now looking at the VSP to HYLD comparison, we see the same thing where they're performing close at the start of the year, and then they start to diverge once the dividend distributions start to get paid out. So in general, this again looks to be performing as expected. We can also try and compare the two indexes and ETFs with each other. For the indexes in VFV and VSP, these two are essentially the same in that they hold all the 500 S&P 500 companies in their underlying. Where they differ is that one is currency hedged and the other is not. So in the case of VFV, it is unhedged and would see the benefits of a strong US dollar, which is what we could attribute the gap between the two lines to be. Clicking on the line to see the values, we have VFV at 30.85% and then VSP at 22.37%. Then taking the difference, that would equal to an 8.48% differential. If we then go to Google and take a look at the exchange rate between the Canadian dollar and the US dollar, we get an approximate 7.85% drop over the course of this past year. It's not going to be exact, but this goes to show that picking a hedged or unhedged version can impact your returns by a fair amount if one currency is underperforming significantly in a given year. Then when it comes to USCL and HYLD, this is a bit more complicated to try and explain. The main differences between these two are the underlying holdings, where I mentioned in the last video that HYLD contains a sector mix that is broadly similar to the S&P 500 and doesn't actually own all 500 companies. So what HYLD actually owns is approximately 87 companies out of the 500, which equates to approximately 17.4%. The other main difference is that HYLD is Canadian dollar hedged, whereas USCL is unhedged. Another component that can also contribute to the difference is each fund's active management strategy for writing options, but that would be much more complicated to try and track. For those who own both of these, you'll probably have noticed that HYLD has definitely been more volatile of the two, where the up days are generally higher, but the same is also true for the down days. We can see this reflected in the chart, where the peaks and valleys are usually higher or lower than those of USCL. There are also a lot of occurrences where both HYLD and USCL cross over one another throughout the year. So while the currency hedging should have acted as a detractor since the Canadian dollar has been down this year, the concentrated selection of HYLD could have led it to outperform during parts of this year. But over the last couple of months, it looks like it has been treading water and staying fairly neutral and within a range, while USCL has been seeing a slight and gradual increase. But keep in mind that we're just only looking at the price return here, and that when we look at the total return, things could be a bit different. So let's scroll down now and take a look at how all of these will compare. At first glance, you'll see that the lines are much closer now compared to the stock price chart above, and that's because all the dividend distributions have now been added back to the price. Taking a look specifically at the VFV to USCL comparison, we can see that the two have been very closely aligned throughout the entire year. There were parts where VFV was ahead, but in the most recent months it looks like USCL may have pulled ahead slightly again. If we were to cross-reference this with the Canada Stock Channel, we can see something similar, but instead here we have VFV ahead by a very slim margin of 0.06% in total return. So at the very least, we can say that these two are basically on par or tied with one another in terms of performance this year. But if you're not using the dividends to currently live off of, and have been reinvesting the dividends, then that would have led to an outperformance of about 2.15%. Now switching to the VSP and HYLD comparison, we see something similar to VFV and USCL, where they remain close throughout most of the year up until approximately July, where HYLD starts to pull away a bit and remain ahead up until now. So it looks like there's been a clear win for HYLD by staying ahead for about half the year. If we were to cross-reference this with the Canada Stock Channel, we can see that without dividends reinvested, it also shows an outperformance of approximately 0.54% in total return. Then if we were to look at it with dividends reinvested, it shows an even greater outperformance by approximately 1.63%. We're now looking at just USCL and HYLD again. We see a similar chart before where USCL has remained ahead in the past couple of months, though the gap seems to be a bit larger than the one in the previous chart. If we look at the values from the latest day, we have 33.31% for USCL and 24.93% for HYLD. By calculating the difference between them, we get 8.38%, which if you remember earlier when we looked at the currency exchange difference, it was approximately 7.85%. So some of the outperformance here by USCL over HYLD could be attributed to the currency hedging, but also other factors such as the stock selection and active management from the funds playing a role as well. In the past few months from just monitoring my own portfolio and the day-to-day changes between these two ETFs, I did also notice a more steadier and clear performance advantage for USCL. So while HYLD has definitely performed very well so far this year, I think there's something to be said about the difference in currency hedging that has played out lately. But keep in mind that this could also change in the other direction as well and work against USCL if the Canadian dollar were to strengthen and outperform. I currently own both of these funds and have invested equal amounts into both, so there's definitely some food for thought that has come up through these comparisons. My yield on cost for HYLD is currently 14% because of how early and often I was buying back when it dropped, so that is definitely something working to its advantage. In any case, anybody who has owned either of these funds should be very happy with the performances here and should continue to enjoy the consistent dividend distributions each and every month. Moving on now to the NASDAQ comparison with QQCL. I'm not sure if investing.com has been watching my videos, but the values for the entire year for 2024 have now been fixed for QQCL. So we now finally have a full year's worth of data to look back on for performance. Starting with the stock price comparison, we can see much of the same as the S&P 500 charts, where they perform similarly until the dividend distributions start at the end of January. What's impressive about this chart is how very gradual the difference is, and for the last few months, QQCL looks to have kept up with QQC while also paying out a dividend distribution every month. It's pretty clear that QQCL is going to show an outperformance once the distributions are added back in. So let's go ahead now and scroll down to see the total return chart. So as noted in the chart above, performances between the two have been very close, with QQCL out ahead leading by a small margin for most of the year. There was a 3-month period in the middle of the year where QQC moved ahead, but that reversed quite quickly and we have QQCL outperforming the index consistently up until today, where it is still ahead. If we now reference it with the Canada Stock Channel, we see similar results where QQCL is again ahead of QQC by 0.78%. Then with the dividend reinvestments, QQCL is outperforming QQC by a wider margin of 3.52%. So here it looks like both the sources show an outperformance by QQCL over QQC, and it looks to be fairly consistent at least for the last 2 months or so. Finally, we have the TSX 60, where we'll compare with CNCL and HDIV. As shown in much more detail in the last video, I just want to once again preface that comparing XIU to HDIV might not be an accurate representation, because a significant amount of HDIV is actually comprised of US stocks, and it only holds approximately 70% of the companies in the TSX 60. So an outperformance here by HDIV should come as no surprise, but there isn't another index in which it can be compared to. Now beginning with the XIU and CNCL comparison, we see the same thing where they track closely until the first dividend distribution is paid out. But here over time, because the Canadian market has been underperforming and as more distributions have been paid out, CNCL actually ends up dropping below where it started at the beginning of the year to show negative returns in terms of price performance. Of course, as you should know by now, when we look at it from a total return perspective later on, it'll show something different. Then if we now look at the XIU and HDIV comparison, we see that HDIV was actually keeping up with the index while also paying monthly distributions up until the end of July or beginning of August. I'm not sure what happened there for it to drop so much all of a sudden, but in terms of stock price performance, the gap has remained fairly consistent. Moving on now to the total return chart and then looking at the XIU and CNCL comparison, with the dividend distributions included, it has actually maintained a positive return all year long. It has been slightly underperforming fairly consistently since the middle of the year, but in this last month, it looks like the index has dropped enough for CNCL to have caught up a bit. Looking at this now with the Canada Stock Channel values, it shows a similar performance, with the difference between the two being a bit higher at about 4.64%. With dividends reinvested, it unfortunately still shows an underperformance by CNCL with a difference of 3.97%. So out of all the funds we talked about in this video, CNCL appears to be the only one that is underperforming its index. I don't personally own this fund, so I can't really comment on why that has been the case. Then for the XIU and HDIV comparison, again as mentioned, it shouldn't come as a surprise that HDIV comes out ahead in performance and has maintained an edge for basically the entire year. If we look at it on the Canada Stock Channel, it again shows an outperformance by HDIV compared to XIU by 1.67%. With dividends reinvested, that difference becomes 2.47%. So when it comes to the TSX 60, it appears that XIU would be the better choice if you want a pure Canadian exposure and the highest total returns. But if you're not as concerned with the total returns and prefer to receive a consistent monthly dividend while having Canadian exposure, then CNCL would be a decent option. For those who want more of a blend, then HDIV would be a good option that has both Canadian exposure as well as some US exposure. And just like that, we come to the end of 2024, and I basically looked at a full 12 months of data now to compare these leveraged cover call ETFs and their respective indexes. When I had started making these comparison videos, I definitely did not think these ETFs would have been able to maintain their performances with their underlying indexes for the entire year. Of course, there are ebbs and flows back and forth throughout the year where the index would outperform the ETF and vice versa. But for passive income investors, these have been great and consistent dividend payers every month to either help you live off of or to reinvest for higher returns. For myself, I own USCL, QQCL, and HYLD. All three of these have performed very well in total return, with USCL up 28.45%, HYLD up 36.7%, and QQCL up 18.55% as of recording this video. They are all core holdings and ones I'll continue looking to grow and rely on for stability within the portfolio. Now looking forward into the new year, should I continue with these updates? Let me know in the comment section below, because a lot of effort goes into all of these videos, so I want to make the most of my time and value when putting these together. If you appreciate this kind of content and want to support the channel, feel free to subscribe and give the video a thumbs up. My goal for YouTube this year is to try and get to 1,000 subscribers, and right now we're at 525, so any help would definitely be appreciated. Finally, if you want to take a look at the data and charts on these comparisons for yourself, I'll leave a link in the description to the spreadsheet. Thanks for watching, and I'll see you in the next video.